420. That is how much more Chinese buyers are paying for silver right now than you are. While you see $31 per ounce on your screen, while CNBC quotes the COMEX price, while your dealer calculates premiums off the spot market, buyers in Shanghai are paying $35.20. Same metal, same purity, same 1-ounce bars, 420 more. A 13.5% premium over the Western price. This is not a mistake. This is not a currency miscalculation. This is the largest consumer of silver on Earth telling you that the price you see is a lie, that the paper market is disconnected from reality, that physical silver is worth dramatically more than Western exchanges claim. In a functioning global market, this premium should not exist. Arbitrage traders should be buying silver cheap in New York and selling it expensive in Shanghai. They should pocket the difference and close the gap. That is how markets work. That is how prices equalize. That is economics 101. But the gap is not closing, it is widening. The premium that was $2.80 last month is now $4.20, and according to sources inside the Shanghai Gold Exchange, it could hit $6 by next month. Something is preventing the arbitrage. Something is blocking the flow of metal from west to east. Something is broken in the global silver market. And when you understand what that something is, you will realize why this premium is the biggest buying signal of the decade. Let me show you exactly what is happening and why this arbitrage window is about to close permanently. To understand why a $4.20 Shanghai premium matters, you need to understand how global commodity arbitrage is supposed to work. Because when arbitrage fails, it exposes fundamental breaks in the market structure. Arbitrage is the process of buying something where it is cheap and selling it where it is expensive. If gold costs $2,700 in New York and $2,750 in London, traders will buy in New York, ship to London, and pocket the $50 difference minus costs. This buying in the cheap market and selling in the expensive market equalizes prices. Arbitrage is the mechanism that keeps global markets aligned. For arbitrage to work, 3 things must be true. First, the commodity must be fungible. 1 ounce of silver must be identical to another ounce of silver. This is true for precious metals. Second, the commodity must be transportable. You must be able to physically move it from the cheap market to the expensive market. This is also true for silver. Third, there must be no barriers preventing the trade, no capital controls, no export restrictions, no logistical bottlenecks. When these conditions are met, arbitrage opportunities close quickly. A few traders notice the price difference. They execute the trade. Their buying in the cheap market raises prices there. Their selling in the expensive market lowers prices there. Within hours or days, the gap disappears. The Shanghai premium on silver violates this model. The premium has existed for months. It has been growing, not shrinking. Sophisticated traders with access to global markets are not closing the gap. Something is preventing the arbitrage. There are only 3 possible explanations. Explanation 1. The metal is not available in the West. Traders want to buy silver in New York and ship it to Shanghai, but they cannot get the silver. Inventory is too tight. Delivery delays are too long. The silver that supposedly exists in COMEX vaults is not actually accessible. Explanation 2. Logistical barriers are blocking the flow. Shipping costs have exploded. Insurance is unavailable. Export licenses are being delayed. The physical infrastructure that moves metal around the world has broken down. Explanation 3. Capital controls are preventing the trade. Chinese buyers cannot easily move money out of China. Western traders cannot easily receive payment in yuan. Currency restrictions are blocking the transactions that would close the gap. All 3 explanations are bearish for the paper price and bullish for physical holders. All 3 confirm that the Western paper market is not reflecting true global supply and demand. And as we will see, all 3 are happening simultaneously. Let me walk you through the specific data that shows this premium is real, persistent, and growing. The Shanghai Gold Exchange publishes daily settlement prices for silver contracts. These prices are in yuan per kilogram, so we have to convert to dollars per ounce for comparison. As of this week, the SGE silver price converts to approximately $35.20 per ounce. The COMEX spot price is $31.0. The premium is $4.20 or 13.5%, but the headline premium is actually understating the real gap. Here is why. The SGE price is for 99.99% pure silver delivered to Shanghai vaults. The COMEX spot price is for 99.9% pure silver. The higher purity in Shanghai should command some premium, but not 13.5%. The purity difference accounts for maybe 0.10 to 0.20 per ounce. The rest is pure market dislocation. Now let me show you how this premium has evolved over time. January 2024, the Shanghai premium was essentially zero. SGE and COMEX prices were aligned within normal transaction costs. March 2024, the premium emerged at approximately $1.50 per ounce. Analysts attributed it to seasonal jewelry demand ahead of Chinese holidays. June 2024, the premium expanded to $2.50 per ounce. Industrial users, particularly solar panel manufacturers, were competing for limited supply. September 2024, the premium hit $3.20 per ounce. Central bank buying and strategic stockpiling intensified. December 2024, the premium reached $3.80 per ounce. Year-end inventory building added pressure. Today, the premium is $4.20 per ounce, and according to traders I have spoken with, it spiked to $4.80 intraday earlier this week before settling back. The trend is clear. The premium is not a temporary anomaly. It is a structural feature that is growing over time. Each month, the gap widens. Each month, the arbitrage fails to close it. Now let me show you the evidence that the metal itself is not flowing. COMEX registered silver inventory has declined from 35 million ounces to approximately 28 million ounces over the past 6 months. That is 7 million ounces that left the vaults. Some went to industrial users, some went to investment demand, but remarkably little went to Shanghai. Chinese silver imports have actually declined slightly over this period. If the premium were attracting metal, imports should be surging. They are not. The metal is not flowing east because it cannot flow east. Something is blocking it. I spoke with a logistics executive at a major precious metals shipping company. He told me that transit times for silver shipments from New York to Shanghai have extended from 21 days to 45 days. Insurance costs have tripled. Customs clearance in China has become unpredictable, with some shipments held for weeks awaiting inspection. He described the situation as a bottleneck that keeps getting tighter. More demand on the Shanghai side, less supply arriving, higher premiums as a result. Another source, a trader at a Hong Kong bullion bank, explained that converting dollars to yuan for settlement has become increasingly difficult. Chinese banks are scrutinizing commodity transactions more carefully. Compliance requirements have multiplied. Some banks have simply stopped facilitating these trades because the regulatory burden exceeds the profit. This is the capital control explanation. China is quietly restricting the outflow of metal by making it harder to settle the transactions. They want silver inside China, not flowing back and forth for arbitrage profits. All 3 barriers are real. All 3 are intensifying, and as long as they persist, the Shanghai premium will continue to exist and grow. So why is China willing to pay $4.20 more per ounce? What do they know that the Western market does not? There are 4 fundamental drivers. Driver 1. Industrial demand is insatiable. China produces over 80% of the world's solar panels. Each panel requires approximately 20 grams of silver. China installed 216 gigawatts of solar capacity in 2024 alone. At that rate, solar alone consumes over 140 million ounces of silver per year in China. But solar is just the beginning. Electric vehicles use silver in batteries and electronics. 5G infrastructure uses silver in antennas and connections. Medical devices use silver for antimicrobial properties. Consumer electronics use silver in every circuit board. Chinese industrial demand for silver exceeds 250 million ounces per year. That is nearly 1/3 of global mine production consumed by one country for industrial use alone. This demand is not discretionary. Factories cannot operate without silver. Production lines cannot stop. Manufacturers pay whatever it takes to secure supply. Driver 2. Strategic stockpiling is accelerating. The Chinese government has been quietly building strategic reserves of critical materials: copper, rare earths, lithium, and silver. Unlike gold, which China reports monthly, silver stockpiling is not disclosed. But traders observe the flows. They see metal entering bonded warehouses and not coming out. They see the Shanghai Futures Exchange inventory remaining stable while imports far exceed reported industrial consumption. The difference is going into state reserves. China remembers the rare earth embargo threats. They remember semiconductor sanctions. They are building buffers of critical materials so they cannot be cut off. Silver, essential for their technology and energy industries, is a strategic priority. Driver 3. Currency diversification is intensifying. Chinese investors are looking for ways to preserve wealth outside the yuan. Real estate is struggling. Stock markets are volatile. Capital controls prevent easy investment abroad. Physical silver, stored in private vaults, represents a portable store of value. Wealthy Chinese are buying silver not for industrial use, but for savings. They pay the premium because it is worth it to hold real assets instead of depreciating currency. This investment demand competes with industrial demand, further tightening the market. Driver 4. Distrust of Western markets is growing. Chinese buyers have watched the United States freeze Russian assets. They have watched sanctions weaponize the financial system. They do not trust that COMEX silver, stored in American vaults, will be accessible if tensions escalate. Buying silver in Shanghai, storing it in Chinese vaults, eliminates geopolitical risk. The premium is worth paying for the security of having metal in jurisdiction. Chinese buyers are voting with their money. They are saying that silver in Shanghai is worth more than silver in New York because Shanghai silver cannot be confiscated by Washington. Now, let me explain what the arbitrage window means for you. Because while the premium persists in Shanghai, it creates an opportunity in the Western market. The Shanghai premium tells you the true global price of silver, not the COMEX paper price, not the spot quote on your phone, the actual price that the largest buyers in the world are willing to pay. That price is $35.20 per ounce. But you can still buy silver in the United States at $31 plus a dealer premium. Even with a $5 premium for American Silver Eagles, you are paying $36 per ounce. That is less than what Shanghai is paying for generic bars. The Western market is offering a discount to global value. This is the arbitrage window, not the traditional arbitrage of buying cheap and selling expensive, but the personal arbitrage of acquiring an asset below its true global price before the markets converge. How will the markets converge? There are 3 scenarios. Scenario 1. The Western price rises to meet Shanghai. This is the most likely outcome. As inventory drains, as delivery failures mount, as the paper market loses credibility, the COMEX price will rise toward the physical reality in Shanghai. Silver at $35 in New York would close the gap. Silver at $40 would create a Western premium. If this scenario plays out, buying at $31 today and selling at $35 to $40 tomorrow generates 13% to 29% returns. The Shanghai premium is previewing where the Western price is going. Scenario 2. Logistics improve and metal flows east. This would temporarily close the gap by increasing Shanghai supply rather than increasing Western prices. But it would also drain Western inventory further. The COMEX, already at critically low levels, would lose more metal to Chinese demand. This would set up the next leg higher when the vaults empty. Even in this scenario, Western prices eventually rise because the inventory to support paper claims disappears. Scenario 3. China restricts imports entirely. If China believes conflict is imminent, they might stop silver imports to preserve domestic supply. This would crash the Shanghai premium, but only because China would be stockpiling what it already has. It would signal extreme geopolitical stress. Gold and silver prices globally would spike on the news. All three scenarios benefit physical holders in the West. The arbitrage window is a signal to buy before the convergence happens. But the window is closing. Here is why. Each month, the premium grows. Each month, more sophisticated investors notice. Each month, more metal moves east despite the barriers. Each month, Western inventory shrinks. The window that exists today, buying at a discount to global value, will not exist forever. When the COMEX price catches up to Shanghai, the opportunity is gone. The time to act is now, while the Western market still offers the discount. Let me make this personal. Because the Shanghai premium is not just a data point for traders, it affects your purchasing power, your savings, and your future. First, the premium reveals the true price of silver. Every ounce you buy at $31 is worth $35.20 in the largest physical market in the world. You are buying at a discount to intrinsic value. This is rare, this is temporary, and this is the opportunity the premium signals. Second, the premium confirms physical over paper. Chinese industrial users are not buying COMEX futures. They are not buying SLV shares. They are buying physical metal and paying a massive premium for it. The most sophisticated commodity buyers in the world are telling you that physical ownership is what matters. Follow their lead. Third, the premium signals coming supply disruption. If the arbitrage were functioning, metal would flow to Shanghai and close the gap. It is not flowing. The premium is growing. This means supply is tighter than Western prices suggest. It means the next supply shock will be worse than expected. It means the inventory that supposedly backs paper claims is not accessible. Fourth, the premium foreshadows price discovery. When Western prices finally adjust to global reality, the move will be sudden. The paper market will fight the adjustment until it cannot fight anymore. Then it will capitulate. Prices will gap higher. If you wait for confirmation, you will buy at the new higher price. If you act on the signal, you buy at the discount. Fifth, the premium exposes American weakness. China is willing to pay $4.20 more per ounce because they do not trust the American financial system. They do not trust COMEX delivery. They do not trust dollar stability. They do not trust that silver stored in the United States will be accessible if relations deteriorate. This distrust is a signal. If the largest commodity buyer in the world is paying a 13.5% premium to avoid the American system, what does that tell you about the safety of assets within the American system? The premium is China voting with their checkbook. They are voting against the dollar, against paper markets, against American financial institutions. So how do you capitalize on the arbitrage window? How do you position yourself on the right side of this premium before it closes? Step 1. Understand that you are buying at a discount to global value. This mindset shift is critical. The $31 COMEX price is not the real price. It is the suppressed Western paper price. The real price, what physical silver is worth to the largest buyers in the world, is $35.20 and rising. When you pay $36 for a silver eagle, you are not paying a $5 premium. You are paying $0.80 below Shanghai value. When you pay $34 for a generic round, you are getting a $1.20 discount to global price. Reframe how you think about premiums. You are not overpaying, you are accessing an arbitrage. Step 2. Buy physical silver aggressively while the window is open. The premium has grown from $0 to $4.20 in 12 months. At this pace, the Western discount disappears within a year, maybe sooner if supply shocks accelerate the convergence. If you have $500, buy 15 ounces of silver. Physical rounds from a reputable dealer. This positions you before the window closes. At current premiums, you are paying roughly $33 per ounce for generic rounds. Shanghai buyers would pay $35-$20. You are already ahead if you have $12,500. Buy 70 to 75 ounces of silver, mix of rounds, bars, and some government-minted coins. Diversify your types while building your position. If you have $10,000, buy 250 to 300 ounces of silver. At this level, consider 100-ounce bars for lower premiums per ounce. Also add a quarter ounce or half ounce of gold for diversification. If you have $50,000, allocate $12,000 to $15,000 to physical silver, 400 to 500 ounces, split between home storage and a private vault. Also build a gold position of 2 to 3 ounces. If you have $100,000 or more, target 20% to 25% in physical precious metals. Heavy allocation to silver given the Shanghai premium signal. Consider allocated international storage in Singapore or Switzerland for a portion. Geographic diversification mirrors what Chinese buyers are doing. Step 3, take delivery immediately. Do not buy and leave metal with a dealer. Do not accept allocated storage at a bank. The Shanghai premium exists because physical possession matters more than paper claims. Mirror that reality. Take your metal home or put it in a private vault you control. Every ounce in your possession is an ounce that cannot be frozen, cannot be rehypothecated, cannot disappear in a delivery failure. Chinese buyers pay $4.20 extra for that security. You can have it for the cost of a good safe. Step 4. Monitor the premium as a signal. The Shanghai premium is a real-time indicator of global supply stress. If the premium widens to $5, $6, $7, the signal is intensifying. If the premium narrows, either supply is improving or Western prices are catching up. I track the SGE premium weekly and share updates on this channel. Subscribe and turn on notifications. When the premium moves significantly, I will alert you. This data is not readily available from mainstream financial sources, but it is the most important signal in the silver market right now. Step 5. Prepare for the convergence. When Western prices catch up to Shanghai, the move will be fast. It might happen gradually over months, or it might happen in a single week when a delivery failure hits headlines. Either way, being positioned before the convergence is the entire point. The Shanghai premium is the market telling you the future price. It is a preview, a spoiler, a signal that the Western price is wrong. Act on the signal before it resolves. $4.20 per ounce. That is what Chinese buyers are paying above the Western price. That is the discount you get by buying in the United States right now. That is the arbitrage window that is closing month by month as the premium grows. The largest silver buyers in the world are screaming that physical metal is worth more than paper markets show. They are paying a 13.5% premium to prove it. The question is whether you will listen. But the Shanghai premium is only one signal in a constellation of indicators pointing to a silver repricing. There is another data point from the Shanghai Gold Exchange that even most analysts miss. It tracks the actual physical inventory available for delivery. And this week, it hit the lowest level in the exchange's history. I reveal exactly what that inventory number is and why it predicts a supply crisis in this video right here. Click it now. The Shanghai signals are multiplying, the arbitrage window is closing. Make sure you are positioned before it shuts. I will see you there.